hour, we talked about the looming tariff threat directed at Canada and what it means for the economy. But in the stock market, if you've been watching action this week, you could certainly make a very strong argument that trade tariffs are draining investor appetite for riskier assets. So I want to bring in Sean Dranfield, he's CEO of Performance Trust Asset Management, to get his take on the mood of the markets when it comes to that very touchy subject. Sean, what have you been observing?
Good morning, John. Thanks a lot for having me on your show. I think, what's interesting is short-term financial market movements are really sort of like the poster child for ADHD. And what ends up happening is people are focused on short-term, news. And the nugget of today is downward pressure on the economy as a result of potential job losses in the federal workforce in the U.S., limitations on spending by the federal government, and frankly, all of those things may have downward pressure on the economy. And that has an impact on how the market thinks about both stocks and bonds. And then on a bottom-up basis, I think, NVIDIA recent earnings, was a bit of a negative surprise, despite the fact that they're making, plenty of chips and there's more demand than chips that they're making. And then finally, I think the other big change has been the shift in the administration. And really, from a news perspective, the last administration was quite, sleepy in terms of news, and it was quite predictable. And obviously, with the new administration, you've got a massive uptick in both volume and unpredictability. And I think that has had an impact on markets recently. And of course, we can always look back and analyze that in the rearview mirror.
So if you had to take all of that, thank you for that, and try to turn it into some investment advice, where would you be looking in the market? Like, what would be the kinds of things you'd be recommending to investors right now?
Yeah, so if you take the view that there is potential downward pressure on the economy, that could potentially be bad news for stocks, right? And generally, if there's inflation, that's good news for stocks. So if you buy into the argument that there's downward pressure in the economy and there's a disinflationary pressure on the economy, that might be better for stocks, worse for stocks and better for bonds. And certainly, if you look at the way bond yields have moved recently, the market, sort of believes that. Whether or not it actually comes to practice in the end, we don't know because no one can predict.
So when you talk about bonds, if there is something in that market that is appealing to you, obviously it's a massive market. We don't often talk about it as much, but it's much larger than the stock market. Are there any examples of fixed income that you like?
Yeah, so the first thing I would say is the massive difference between bonds and equities is equities operate in this sort of unknown universe, right? So I may not know what Tesla's earnings or price may be in the future, but with a bond, the income stream, unlike a dividend, is a contractual obligation and it's repeatable over time. And I may not know what interest rates are going to be in the future, but even if I don't know, the price of a bond is knowable in different interest rate environments. So the way we think about bonds is we take the view that you can't predict whether or not interest rates are going to go up or down. So let's try to build a portfolio that has a balance of bonds that may help you in a rates up environment with bonds that may help you in a rates down environment. So I would call rates down bonds offense and rates up bonds defense. So in a defensive sense, we really like top of the capital structure, commercial mortgage-backed securities that are interest only. So with these bonds, unlike a traditional bond that has a principal payment at the end of their life, you're just clipping a coupon over 10 years with these bonds, and they tend to be less interest rate sensitive, so they'll help you if rates go up. In a rates down environment, given how tight corporate spreads are right now, we really like the 20-year part of the Treasury market and 15 to 20-year taxable munis. We think those bonds, if rates go down, will perform very well versus other bonds in the U.S. bond market.
Okay, Sean, thanks very much, and we'll show our audience just a recap of some of what you're suggesting there as opportunities. Great to get your analysis. Obviously, as you noted, never a dull day these days. We'll see how it all plays out. That's Sean Dranfield of Performance.